Hello and welcome to this week's instalment of Nucleus Investment Insights. This week our attention turns to perhaps the biggest question now facing the world of investment. Is now the time to re-enter the stock market? It's certainly been a popular question with both our current clients and people I've been speaking with who are interested in investing with us, and I for one cannot hear more about the subject. I'm joined today by the men who called the crash to work through our take on the big question and how we plan to implement the answers. So I'm joined today with our Chief Strategist, David Llewellyn-Smith. G'day, David.
G'day, Tim.
And our Head of Investments, Damien Klassen. Hello, Damien.
Hi, Tim.
Fantastic. And just a quick reminder before we get started to subscribe on YouTube and click on the notification bell to be notified of when we go live and have a new webinar to watch, and follow us on your preferred podcast platform. And for those listening in live now, feel free to drop in a question in the chat box below to have them answered along the way. So to get into it, is it time to take the plunge? The agenda for today, we're going to be looking at the bull case, running into the virus itself, looking at central banks, government stimulus, pent-up demand, the question of timing and rebalancing, and then, of course, how to invest and how we're looking to invest through the portfolios here at the MB Fund and Nucleus Wealth. So with no further ado, let's kick off with the bull case. Damien.
Yeah, so look, this is just a quick list run through of some of the most popular ones we hear, and you know, there is a if you think that it's just the virus which is a problem, and that once the virus is cured, then it'll go away, then I think this is the reasons why you'd see to get out and buy. So on the virus front, case counts are starting to fall in a lot of countries. It does look like it's possible to get it under control. There's hopeful signs in sort of vaccines and cures that pop up, and questions about when those will come on. If you've got central banks, then there's a mantra out there which is "don't fight the Fed," which is basically whenever the Fed's pumping as much money as they can into the market, then assets are going to go up in value. They've already started buying corporate bonds. The question is, are they looking to start buying equities even, which is what you see in Japan? They're out. So the central bank there buys equities, and so do you have central banks around the world just printing so much money that you just shouldn't stand in the way of it? In terms of government stimuluses, it's looking like going to be the largest stimulus ever globally, and pretty well coordinated in terms of the amount of money that's coming. We've got this pent-up demand. These people, everyone sitting at home who still has a job, saving all this money because they can't spend it, and so once they do get out, they're going to rush out and spend all that money. And then there's just sort of this whole timing and rebalancing. So, stock markets are down sort of 25% or thereabouts. Government bonds anyway are up. And so it's the question for a lot of people saying, okay, well, now's the time to rotate. Start selling down my bonds and buying into stocks, because everything moves in cycles, and we've had that down market in the stock market, and now it's their turn to go back up again. So I think, David, I don't know, is there any other bull cases that you see from that?
No, I'm ready to buy after that assessment, Damien.
Yeah, that's right. just hang up and hang up the phone and get out there.
Yeah.
So let's deal with the virus though, because the thing for us is it's and I'll jump to the next slide. Just sort of showing some of the virus turning the corner stats. I quite like that graph from the Grattan Institute this morning, just sort of showing that there's a few countries starting to get it under control, and the number of new cases is falling off at a few places, and so certainly showing it's possible. But the big issue is really on the next slide, is that it's not the virus, and the virus is the pin. And I could go through a bunch of different factors on these, but the real one is saying, if you're of the view that it's just the virus that's caused this, then when the virus goes away, everything's fine again. If you're of the view that we already had weak economies, we already had over-indebted corporates, over-indebted households in some countries, Australia in particular, but a number of other countries were relatively indebted to where they've been in the past, and over-indebted governments, then this virus is really just sparking the end of the cycle. We've had a very long cycle. but cycles don't go forever, and is the virus just the end of this cycle? So David, I might kick to you for.
Sure, I'd just add to that. You've got the US corporate debt to GDP chart there. There are, three other sort of outstanding imbalances that we can point to that are, similar cyclically. One being Australian household debt. It's been at a very high plateau for some time, but is clearly causing quite a lot of difficulty for households, and so that's something that you have to ask yourself: is sustainable, and whether or not this virus becomes a pin. European banks, which have really struggled to be profitable ever since the GFC, with an endlessly flat yield curve and some other problems dogging them as well. And then at the moment we have difficulty in the fiscal settings in Europe, where it's looking quite contested over whether or not they're going to save the South with Eurobonds, etc. And so that's again another one of these kind of peak cycle charts in Europe, where the virus could again, create havoc. And then finally, we got China.
So sorry, Dave, just to cut you off there. That's similar to what we saw in the financial crisis, where the financial crisis hit. Sort of everyone had these problems, and then afterwards it was like, well, just a minute, how's Italy going to pay it back? How's Greece going to pay back? How's Spain going to pay back? It's
exactly right.
Yeah.
I'd just add that this time, it's lives at stake, and as opposed to dollars and cents. So if anything, the politics is going to be much more incendiary. And so then finally China. Now we all know China's extraordinarily indebted for its stage of development, let alone in general. And it owns its banks, so we don't see a pop. But again, this is a serious shock, and you've got to ask yourself how that plays out for the leverage in that system, not just the virus and the shock itself.
David, just a quick one there. We've got a question here. Is it possible that China recovers faster than the USA? And what implications could that have for Australian investors?
Well, I mean, that is happening right now. That said, I think the message that's coming out of the Chinese recovery, largely ignored, is how troubled it is rather than how swift. Most of the sort of fast-moving day-to-day indicators for its industrial output are stuck around 80%. Some bits and pieces have come on a bit better that, always get the usual stimulus help, things like empty apartment sales and what have you. But even they are still down considerably. So, yes, China is recovering. It's certainly going to recover earlier than the US, because the US has only just gone down in the last couple of weeks. In the longer run, well, let's look at it in terms of quickly medium term. China is going to struggle to get much past where it is at the moment in terms of its recovery, simply because it's going to be building stuff that nobody wants to buy. It'll be inhibited by commodity shocks, et cetera, that are coming out of the global economy. Some of them will benefit it too. So I can't see China leading a global recovery. I just don't think it's got the oomph to do it this time, especially with its various kind of credit issues. And then you have the US going into this and making it worse, obviously, for China too. And then it will go through the same recovery process, which I expect actually will also be quite difficult. So, it's a kind of question, if you fast forward 3 months and say the virus is largely contained in both countries, are they both in some V-shaped boom? No. Can you see China escaping the global downdraft enough for it to matter to Australian investors, insofar as, various assets will differentiate? I don't think so. I think the key in terms of Chinese input to, for instance, the Australian dollar is bulk commodities. I think they're likely to slide from here rather than go up, just through the sheer mystery of China managing to hold them up. But anyway, my guess would be.
But the question as well for those, the question for those, Dave, is really, isn't it that will Chinese demand be enough for the demand you're going to see lost elsewhere around the world?
Exactly.
So yes, China's going to start rebuilding and start pushing as much as they can, but they are only a certain proportion of the world, even though it's a huge proportion of commodities, but
Yeah.
there is the rest of the world that's in lockdown.
Yes, that's right. So I don't think that they can differentiate enough for it to matter.
Yeah, and the other part is if you're the world's largest exporter, then and everyone's locked down or in got consumer demand and massive unemployment problems, then it doesn't bode well for you.
Exactly, and none of it's in a vacuum, is it? So you might say, iron ore held up great through the first part of the year, but the Australian dollar collapsed to 55 cents because risk was just getting smashed everywhere. So can you see the Australian dollar rising with an iron ore remaining strong on a Chinese recovery? Sure, but not if the US is going to shit.
Yep. Okay. Just while we're on the corporate to debt, just quickly, another quick question here. Do Australian corporate bonds have the same risks as the USA? So obviously we're looking at the very, very ominous peak in the US corporate debt, Damien, but just a reflection on Aussie corporate bonds?
Yeah, so the issues with the Australian corporate bonds is it doesn't look as bad as the US, but it's not far off. And I think if you broke it out to non-financials, so you stripped out the banks and insurers and just looked at what Australian corporates are doing, it looks lower. But having said that, though, it traditionally is structurally lower because resource companies don't borrow that much because they're very volatile, and so people won't lend massive amounts to them. If you strip out resources, then it doesn't. You're back to not looking, to looking more ominous if you strip out that. The bigger issue for Australia is that the consumers have considerably more debt than anywhere else in the world, except for one country. So yeah, our issue is partly the corporates which aren't in a good place, but mainly the consumers which are in a very bad place.
Okay, all right, fair enough.
But let's jump in and just talk a little bit more about the virus itself. So,
yes, please.
So that we've spoken about this, the hammer and the dance. This has come from Thomas Puyo, I think. But it's very well expressed. But it's basically you need to get the hammer out and get on top of this virus in early stages, and put down on these strict lockdowns. To get those numbers right down. Once you've done that, then it's this dance about saying, it's not just a matter of saying, okay, we've locked ourselves down for 4 weeks, now we can open up and everything will be fine. I mean, the virus is still out there, but it's actually about saying, you need to learn while you're doing that, and you need to set up all the systems so that you can maintain it going forward. So whether it be, bucket loads of testing, like testing on street corners as people walk past, testing people's temperatures as they walk into buildings, At schools in Singapore, they're sort of testing every student before they go into class type thing to test their the temperatures. It's those types of factors that you need to be able to have them all set up, ready to go. You need to have all those testing and tracing and people ready to track down cases when you find them. So that once you are actually open, now you can just start gradually opening more and more things. And you go, okay, we're going to open offices and see how things go. Or we're going to up the gatherings to sort of 20 people or start various things and then see, okay, that one didn't work. We're starting to get an outbreak again. We actually need to come back. And that's that dance part where it's a matter of trying to get your two parts, your education and all these other things going so that you can maintain this this dance going forward. And it's not expected to be, it's not just open up and everything's fine. It's a gradual and seeing what works and what doesn't work.
And probably the key word on there, I think, is ongoing. Like there's actually no real endpoint to that.
Well, I suppose vaccines, but that stage you're probably a year or so away. Yeah, that's right. So that's one part. The other part I wanted to just talk quickly about was this whole forecasting of how many cases there's going to be, how bad it's going to be, and all those types of factors. And I just wanted to highlight that I've sort of titled this one, do you have a monkey and a dartboard handy? Because I've put a link up here to a website that's got a very good calculator in terms of just looking at a standard. It sort of you run 4 different differential equations and you've got all these different inputs you put into it, and it spits out and sort of tells you what are the types of things you can expect. But the key ones I just wanted to highlight is I've used theirs, and I've used roughly what the US is, sort of a 300 billion-ish person on the left there, and just put in the standard, just used all their standard variables for everything, and it spits out and goes, well, there's this curve on the left that sort of shows how it goes up and then it comes down. They put in this intervention on day 100 that then decreases transmissions, and you end up with sort of peak hospitalizations of about 86,000, and you end up with deaths of about 20,000 people. So that all sounds, you put it into the model and it all spits out, and you say, well, what happens if you play with some of these assumptions? And I've just changed 3 assumptions on this graph. So one is the R0, which is basically how many people you give it to. So rather than 2.2, I've called it 2.8. And that one, we really don't know what the numbers are, but it's somewhere between sort of, you can see suggestions, maybe it's up as high as 5, maybe it's down as high as 2, but that's an exponential one. So from 2.2 to 2.8, we're certainly within the realms of possibility without straying too far. I've just said, well, let's say instead of on day 100, you made it day 105, so just given it a 5-day lag, and rather than being a 66% decrease in transmissions by your shutdowns, it's only a 60%. So none of those 3 assumptions are like wildly out of whack from the other ones. And what that means is that your deaths jumps from 20,000 to 3 million.
Wow.
And your peak goes from 86,000 to 16 million hospitalizations.
Poof.
So I guess what I'm really trying to get to is we just don't know. Like, it's these factors there's so many different things that are moving around, and they're all playing with exponential functions. Is that trying to come up and say, I've got a forecast for how many people are going to die and how quickly things are going to happen and all that, these types of factors is basically meaningless in terms of that. What we really think you should be focusing on is the next slide, which is it's all about the hospital system. So this hammer and dance part is really about saying, okay, we know we could get rid of the virus if we wanted to. We could just lock everyone down, and in 6 weeks' time we'll all die of starvation. So we know, okay, that's off the table. We actually do need to have some sort of open up, and we do need to have some sort of
essential
human interaction.
Yep. Exactly.
At the other end, you can say, okay, we could open everything, and then our hospital systems would get completely swamped, and way more people would die. So we're going, what are the parameters that people are really playing with for the hammer and the dance? For us, it's saying, it's about saying, I want people to be in my hospital system. I want to have enough economic activity going, so the disease will actually be spreading. People will be ending up in the hospital system, but it won't be swamped. There will be enough. There'll be enough in the hospital system that enough capacity in the hospital system to deal with people. And most countries, while you're trying to do this lockdown, they are furiously trying to get more hospital capacity, more people trained up to do whatever it is, more equipment to actually so that people can deal with so you can actually have your staff, because they're starting to run out of equipment. So people are flipping around different lines, different manufacturing lines to try and produce masks. There's a lot of car stuff that's out there trying to produce ventilators. It's very important to it. So for us, it's about saying, it's less about the cases, because quite frankly, the case counts, we've got no idea really what the case counts are. Like everyone looks at these, we've got 1.5 million cases or whatever the latest number is for the day. The reality is, we know it's not just China's underreporting. We know that Italy's underreporting. We know Iran's underreporting. We know that in places like Iceland, they've actually done a randomized sample across 5% of the population. That's a small country, obviously, but they've actually done a big study across it and found all these extra cases that aren't being picked up because the people are never sick. And we saw the same thing when South Korea sort of started looking at some of the churches. We saw the same thing when we looked at the Diamond Princess and these other cruise ships. We had whole-scale testing, and you're starting to see it in places like Norway where they're doing randomized testing. So we know the case counts are wrong, but for me, it's not about the case counts. It's about actually saying it's all about the capacity we've got in the hospital system. Can we maintain that? Because then you can start to open up, and then close and open and close as your hospital system. Trying to just keep that hospital system in that spot where you're open enough as much as you can to make sure people are living and getting everything they need, but not so much that your hospital system starts getting overwhelmed.
Just a quick one on that, Damien. The last slide where you were talking about the that exponential chart, does that, effectively the if I go back a slide here, does that factor in that hospitalisation sort of issue where at some point it maxes out the hospitals and then it just goes into sort of thermonuclear mode, or is that sort of something that could be added on top of this?
Yeah, that's added on top of this. And the other thing you miss on this as well, in terms of deaths, is all the other deaths that occur because, you're a cancer patient and you couldn't get in there because
you don't get a bed.
You had a bad asthma and all the ventilators are taken or whatever it is. Like, all these deaths, these are just deaths from the coronavirus. That doesn't include all the other factors that happen. So we're using roughly about 25% of your ICU beds as sort of a rough guide to saying, well, look, if you've still got 75% of your ICU beds left for people who just have genuine, normal, heart attacks and strokes and whatever it is from just being alive, so they're still available. About 25% we think's a reasonable level where, who knows, maybe it's higher than that because you make more or lower, but I guess as a rough rule of thumb is saying, well, that's where we think countries should be targeting to be able to then open back up again and work with the. Okay. So what can you forecast for the virus? And I think that's the key one for us. Is it saying this next slide where we're going so that we can forecast that lockdowns work. So we know these viruses are going to peak because if they don't slow the virus enough, then the lockdowns are stricter. And then if that doesn't slow it down, then you get stricter lockdowns and eventually the virus slows down. So that part is one part is, calibrating the hammer, so to speak. How strict do you need to be? And I think the signs show that the stricter you are, the faster you are and the stricter you are, the sooner you'll be out the other side. Whereas if you try and do, let's be a little bit and then a little bit more and then a little bit more and then a little bit more, you just don't get on top of it. And so and even places like Singapore, which has done a lot on the sort of all these other factors, is even now sort of going into shutdowns because it just needs to get back to that point where they can then, they need to put the hammer on just so that they can then start the dance again and to start lifting and lowering. Face masks it's a bit of a sad one for me. Is that we know they work. I mean, there's stuff about saying, oh look, you can. There's questions out there about saying, well, can you still catch things if you've got it? And yeah, it's true, you can, but it's actually most of the part for the face masks is actually more about not spreading the disease to other people. They work. They don't work for you not catching it. It's good. It stops whatever it is, 50% or something like that, and it often means you get a much lower dose. So that's all good. But the biggest benefit is actually stopping you from spreading it to other people, because that's where it stops, dramatically stops the amount of spread out there. So, and we are seeing some countries, places like the Czech Republic has put like so they're a country in Europe that's put on mandatory face masks and fines if you're not wearing one, and they're getting much lower case counts than countries all around them. So, so things like that. We know summer beats winter. But having said that, it doesn't beat it by enough that if you've got a complacent government or governments who use it to say, well, everything seems to be fine in our country, we must be doing a great job, then it seems that pretty much overwhelms the benefits you get. But if you haven't got that complacency, and I think what we'll see is countries that are moving into summer now and warming up, that will help slow the spread. On the flip side, for countries like Australia, it probably makes it, it'll probably make it harder. We probably won't be able to do as much opening up as what you're seeing elsewhere. And then, this whole part about the opening up needs to be measured, calibrating that dance, and just really focusing on the hospital system is saying that the key focus is don't overwhelm your hospital system, and what can you do to stop that. So I think done correctly, I think you can get reasonable outcomes in terms of you can start getting people back employed, and you'll certainly be well down on where you were last year or the year before. But I think you can have a functioning economy with this. It's not a matter of saying everyone has to lock down for 6 months and nobody go anywhere. I think done correctly, you can end up with this, and I think that's where countries will eventually end up. We've seen what's happening in China. We've seen what's happening in South Korea, and you're sort of seeing that if you play it right, you can have sort of at least semi-functioning economies. So it's not you're not sort of going into complete global meltdown. Dave, I don't know if you've got anything else you want to say on the whole virus part?
No, I'd just add that all governments will probably get to this point, but governments are pretty blundering and large and hopeless, and the cost for making mistakes here is very high, especially when you're in the dance phase. And so, even though this is, I agree, a manageable paradigm, you're going to see very halting, mistake-ridden governments, blundering their way through this, rather than it just being a simple process which enables you to at least have that functioning economy. That's how I would assess it.
Yeah, absolutely. Yep. And if I'd encourage people to go to that website and have a play with some of those calculators. But just looking at it's obviously just a tool to have a look, but you'd be very surprised about just changing the reaction function from by 4 or 5 days. It makes a massive difference to how many cases there are. The faster you get in and lock these things down. So, and that's just as true when you start opening up as well. So if you open up and you start getting a few cases and you decide, well, let's just wait a few more days and see if that helps. Because it takes so long, it's like a delay, you'll probably end up having to put the hammer back down again, because the cases will actually blow out, and dramatically, and then you'll have to be putting people back into lockdown so that you can get it back under control before trying to start again.
Yeah,
so,
that's exactly what's happened in Singapore in the last couple of days. It's been a pin-up buoy of excellence to this point, and then suddenly it's had to revert to hard lockdowns. Because the virus just escaped.
So in that case, David, did they just do a full open, or was it like a staggered open? What do you think they've done wrong there?
They never really closed, but what they did was the part for Singapore was about this really aggressive tracking down cases, which is exactly what you need. You need that extremely aggressive tracking down cases, but the issue was that wasn't enough. So
they basically, because they were so SARS ready, they basically went straight into the dance, right, without having to do the hammer.
Mm-hmm.
But it has proven, the virus has proven it elusive enough to get around their dance, and they've been forced back to the hammer.
Wow. Yep. Yeah, okay. Yeah. Very good. We'll roll into central banks. And we've got a few questions actually relating around this, but we'll get this one kicked off.
Well, let's go to you. I might go to you, Dave, first for Don't Fight the Fed.
Don't Fight the Fed.
Yeah, well, obviously it's just money everywhere, and not a drop to drink. Huge emergency easings all right around the world, led by the Fed, Europe, the ECB. Australia, after a delay, got on board. Probably the odd man out, in fact, is China, which still, I think, fears a falling yuan, and so has been a little more steady. And so, as a component of the bullish case, we have this history of liquidity flows equaling rising stock markets. And so don't fight the Fed is simply that equation where you have the Fed giving out lots of free money, and so you expect stock prices to rise.
Yeah.
Eventually.
The issue though is that liquidity is not equal to solvency. It's not the same. So if you've got a liquidity problem where you need lots more money in the system, and we do have a liquidity problem, but we have a brewing solvency problem as well. And so at a certain point, central banks have to hand over, because unless they're actually going to get in and start buying people's houses to prop up prices and start buying equities in massive volumes, then there's there's issues around how much money can they pump in. And look, theoretically, there's nothing stopping them. Legally there is in a lot of countries, but theoretically, if you own a printing press, you can buy pretty much whatever you want if you get to that stage. But it's more of a question of social dynamics. Will they be allowed to, and do we really want them to? Is their job to prop up all these assets, or and especially if you're looking at assets where earnings are disappearing. So is it the Fed's job to hold up say the stock market at record highs? Is that their job, or is it? And so the answer is no, which I'd like to think it's not. Then is it their job to hold at record high valuations if there's no earnings to support the valuations? Should they still be trying to hold the markets at high levels? And again, I'd like to think the answer is no. And we'll see as time goes on as to how much central banks are going to want to actually try and manipulate those asset prices, and how much is actually more about saying they should be printing the money and giving it to governments so that governments can get out and spend, or printing the money indirectly and giving it to people.
Yeah, sure.
I think that's right. I mean, there's a flow back and forth between these liquidity and solvency poles there, because we can't. The Fed or none of these central banks can actually prevent businesses that have just had enormous cash flow hits from going belly up. That's going to happen regardless. They can kind of extend and pretend on them for a little while, but it's still going to come. And so you're going to get this kind of back and forth as you get more and more mounting defaults, etc. You get more liquidity and more rescues. That won't just be the Fed, the central banks. It'll become more integrated with fiscal as well. And if you combine that with the outlook for the hammer and the dance, you can see this is a kind of, I think, rolling crisis for as long as it takes to get rid of the virus. We've only been running this thing now for what,
6 weeks?
6 weeks. Yeah. I mean, we haven't even had any bankruptcies yet. And we've already got this extraordinary money printing and massive fiscal intervention. Yet a chart will come to shortly. Australia is printing 17% unemployment via Roy Morgan this morning. You've got an extraordinary rush of unemployment coming in the US. This is going to be a tidal wave of defaults. So, at some point, well, that takes us to the solvency end of the insolvency end of of this binary, and it's going to trigger more action. So, while we see a big spike in action here, I expect it to be bloody enormous by comparison to this before this thing is over. Because we're talking about scales of disruption for a system that is very highly tuned and runs on very small margins and high frequency arbitrages being hit with a Mack truck. And so you're going to get this swing back to the liquidity end with more support, more fiscal, etc. So what that basically means is convulsions of crisis and intervention. So in terms of our broad kind of theme today on whether it's time to get in, the answer is, well, you're going to get more opportunities.
Okay, very good.
And so what David said, maybe we'll flick to this next slide, the government stimulus. But as you said, it's about that whole, the markets will get excited about things for a bit because they'll say, hey, the virus is getting a little bit better and everything like that. And then they'll be like, oh, actually, unemployment's worse, or the economic impact is actually worse. And no small businesses are starting up, and so nobody's hiring. And so then you'll have a tumble, and then you'll go government support from whatever will come out. And we've got a new plan to try and get new businesses started, and they'll put that out, and the markets will rally on the back of that, and then the next phase will come through, and okay, it wasn't big enough, or whatever. So
honestly, I don't think it'll be over before most of the Australian banking system is nationalised. I mean, in all seriousness, I cannot see how such sleepily capitalised businesses can absorb this shock over a year, let alone a bunch of years. So, we've got a scale of stimulus ahead, I think, that is still unimaginable. We've got unimaginable stimulus behind us, but, what's going to have to come next? And I'm talking about helicopter money as well, possible universal basic incomes. If you fast forward 6 months, we're in the middle of the dance, and yet the Australian economy is still only operating at 90% its capacity. You've got chronic unemployment. What are you going to do? You've got a rolling banking crisis. The interventions will just
record
continue
levels of
to
debt
scale.
as well.
And record levels of debt. They'll have to continue to scale up. And so you get just this bounce back between crisis and rescue, crisis and rescue.
And so the real question comes back to that whole part about saying, it comes back to the moral hazard issue, doesn't it? In terms of saying, when we can see on here, how much money governments are throwing at the issue, and at the moment they've been throwing most of the money is being thrown at individuals to help sort of get them through the unemployment phase, and help support that. And so the question will come about saying, well, where does the moral hazard start for companies? So if we, does it start becoming, okay, we acknowledge this is a hopefully once in a lifetime event that's massive, and so shareholders, will they say, well, shareholders in banks should be, or we should make them good, or do they go with no, look, they should have, the banks shouldn't have been lending so much money, and they shouldn't have run such, they shouldn't have pumped Australia's household debt up to such high levels, and so if shareholders are part of that, then they'll have to take the pain and bear it. And so there's a lot of real deep sort of moral hazard issues that the government's going to be facing, and I think it's far too early to assume that they're going to do enough.
I think by definition they won't do enough, and then they're forced to do more. Moral hazard will be an issue until it's not. Until, again, the crisis just won't go away and you're forced to act again. Governments are always reactive. They're not going to get in front of it. But they have been quite swift, at least, in coming in with these huge measures. And I would expect that pattern to just keep repeating. So...
Yeah, you got to sort of ask, what else have they got?
They've got unlimited. They've got unlimited ammo. I think Damo's right. Like, at each phase of crisis, there are, the old value systems try to reassert themselves, but I think the crisis just overwhelms them each time until you end up in a world that's, very changed.
A couple of quick questions, fellas. Sorry. Before.
Yeah, I was just going to say, before we jump into that question, it's a whole thought about saying, can our economy, can we maintain our style of life, or at least some style of life in terms of feeding people and clothing them and housing them, with only a small proportion or a much smaller proportion of our population working? And the answer is yes, we can. There's a lot of things that people would like to have done, whether it's saying, well, rather than getting a haircut once a month, I'll have once every 3 months or once every 2 months. And another, there's a whole bunch of things people do that you don't need to do, you like to do, but you don't need to do. And so the question is not, can you survive at this lower, with a lower rate of people working? It's more about how we're going to divide that. How's that going to be divided between the people who happen to be in a job that they can still do, and the people who happen to be in a job that they can't still do. And that whole equality part will come down to government decisions about, yes, what am I going to bail out, or who am I going to help? And so, yeah, a very deep philosophical questions to be answered, which I'm sure we'll be back upon. And sorry, let's go to question 2.
A couple of quick questions here. They're both sort of centre around the same point, so I'll read them both out, but you can probably answer them in unison. So firstly, with all this massive stimulus, will we get inflation appearing, or will it turn to prolonged depression? Will that eventuate and deflation rule? And similarly, can we fast forward 2 to 5 years? Will we have inflation, deflation, or stagflation?
I think the most obvious one is the deflation side. So yes, we've got deflation. It's already coming. You can't have, what are we hitting, David? 17% unemployment or 27% in unemployment without getting a huge lack of demand, and so you lose from that front. In terms of the inflation side, I think there's two parts you need to keep in mind with inflation. You can get inflation from two main factors. One is not enough supply. So are we going to have supply issues in that the core things people want we don't have enough of? And I don't think that's going to be true. I think there will be scope and people will focus on that, but there will be pockets of things that people really want that you'll see significant inflation in. But on the whole, I don't think there's going to be a supply issue in that we can't supply enough of what people are wanting. It's going to be more about the lack of demand. And so sorry, that's one side of an inflation.
Supply inflation from repatriating of global supply chains, but I wouldn't see that as systemic.
Yeah, your real issue with inflation getting away from you is when you've got a demand problem, where you've got too much demand chasing too few assets, and you need to push those up. That's where you get the inflation part. That's where you get troublesome inflation, because supply side inflation it's usually quite localized in particular areas, and then that gets fixed, and more resources get devoted to that, and off it goes. Where you've got too much demand, generally because you've either got too much debt in the economy or too much lending in the economy, that's where it usually comes from.
Or too high wages.
Well, exactly. It's too even wages. You're paying people too evenly, and so all these poor people, all of a sudden want to go on holidays and get better education and all these other things that we should, if we just pay them less, then they'd reduce their demand. And that's the phase we've been in, is where we've been increasing inequalities, and your part where if you keep paying the people at the top more and more, then the people at the bottom, you don't get this increase in demand from inflation, because the vast bulk of people just can't afford to supply, just can't afford to do it. Which is why we're still seeing inflation in things like private schooling, and you're still seeing inflation in some of the high end goods. You still see inflation in that, but you don't see we're not seeing the inflation in the lower end ones. And so, are we going to get that inflation at that high end? Well, look, you could, if governments print enough. You certainly could, but I think that's it's very hard to predict that coming from now. You basically got to, if you're making the assumption that governments are going to print way too much money eventually over the course of this, then coming out the other side, yes, we'll have too much demand inflation. I think there'll certainly be a point, I think, where governments will get to, but maybe not. Maybe we end up more in terms of governments we run into the same problems they did in the Great Depression, where every time you're just starting to get out of this, governments would say, "Oh, okay, we've got to stop printing now," and you'd end up back, drifting back down into another slump. I don't know, David.
Well, I don't just exactly agree with that analogue. I mean, in the short term or short and medium term, the deflationary forces are immense, as your own chart said. And the government stimulus, it's support, not stimulus. There are big problems getting QE into the real economy until there's a proper kind of shift of that towards some sort of QE for Main Street, whatever that form that takes. Whether by fiscal or universal basic income or whatever it is, then there's no hope of inflation. And then, yes, maybe eventually they get to do enough, but it's just a massive deleveraging world. Post-virus, it was already in that kind of state beforehand. And it was China that kind of did the leveraging for everybody post-GFC. It's now going to turn towards deleveraging, or at least disleveraging at best. And so where do you get a consistent kind of leveraging pulse for inflation? That's the moment you pull any stimulus, it'll slow.
Yeah, and actually that's this next slide, Tim, that sort of actually gets into this a little bit, is this the pent-up demand argument that that people who come out of the there are people, there's going to be winners out there who are basically stuck at home, can't spend the money they want to spend, and they're actually going to start saving all this money just because they can't think of something, or they can't get out to spend it, and so they're going to be relative winners. And the question is that going to beat the people who've lost their job and are scrimping and trying to search down the back of the couch for enough change to buy lunch type and we're very much of the view that yes, there'll be some pent up demand, but it's not going to beat the amount of losers. The winners aren't going to beat the losers. And I think as well that you've got that whole factor that in terms of your demand is that there's so many jobs come from the small business sectors, and so many jobs come from people who are entrepreneurs and people who decide to start up businesses and take a step out of the corporate life, out of the safe corporate life, and take risks. I think it's not obviously not everyone will be shaken by this, but I think there's going to be a hell of a lot of people out there who are shaken, and society as a whole is not going to. People in society as a whole are not going to want to get out and take risks, and they're going to be more likely to say, "Oh, should I keep my safe, secure job that got me through this whole crisis, or should I step out and start a new business?" And I think more people than usual are going to say, "No, let me just stick with my safe, secure job that I had that got me through this." And small businesses are going to be, shocked by this, and they're not going to want to get out and hire new people. And so it makes the whole recovery side of it very difficult. So I guess the answer is, do I think there's pent up demand? Yeah, I think absolutely in pockets, but I don't think there's enough pent up demand to offset the amount of losers from the situation.
I mean, I've certainly got pent up demand at the moment. I'm not locked down. I'll be out like that. I ran up a drain price.
That's a kebab shop, though, isn't it, David?
It's all about economic turnover, though, Tim. But David's spot on. We're going to have like an incredible number of idle people, and I'll just break this up a bit by country. Like I think, places like the US, for instance, that are really going to underdo the support. Are going to have huge levels of unemployment and underemployment just because they're so freaking ruthless. So that'll be trouble for them. But in our case, in Australia, I think this is a structural change as well. Like how do you rush back to huge levels of immigration, which has been a crucial growth driver for Australia? If you're running unemployment at 10 or 15%, whatever it ever actually settles out with the ABS number wang, can you really just go straight back to 300,000 people coming in a year and flooding the labour market? And if you can't, then there's all of those growth sectors that have been driving what growth we've had are really struggling, and so your unemployment becomes chronic, and it doesn't just snap back in a V-shaped recovery. And so you'll have a wave of pent-up demand, but it won't last very long, and then you'll settle into a kind of income-crushing grind that goes on for years, which is much like what we've seen, actually, even with the immigration, but we'd have it, instead via very high unemployment and the difficulty growing at all.
Okay. One quick question just before we roll into the how to invest, just in mindful of time as well here. There's questions around distribution between those who can stay in a job and those who can't as a result of the virus. Could be a handy dress rehearsal for a future when we have extensive automation. Although the present situation raises questions of distribution between labour participants, the future situation will raise the question of distribution between capital and labour. What do you think? Probably less of a question, more of a thought.
It is a very good question, yeah, and it's coming back to the heart of this whole supply chain issue as well. If you're bringing your supply chain, if you're saying companies are going to be looking at their supply chains and saying, you know what, it wasn't worth having 100% in China or even 80% in China and 20% in Vietnam. I actually need at least some of it in Australia and or US or wherever the manufacturer is, and possibly diversified around the world. Is that it is very likely that there's going to be a huge increase in automation that's going to be needed to actually do that, and they're absolutely right. That's I guess it's interesting in that if we're going to run this huge stimulus package now to try and get people for because of the inequality between you happen to work in the tourism sector versus somebody who happened to work in a supermarket. And all of a sudden, one of you's lost a job, and the other one, and can't get another one, and the other one's fine, getting extra hours. Is saying, well, where's the? So yeah, I think that'll absolutely go back to that, and you'd think the solutions that governments come up with will probably go across to that same mechanism, but we could probably spend another whole podcast on that. I think there's.
I'll just quickly add, I think the pertinent phrase here is never waste a good crisis. And so companies won't, big corporates won't. And so there will be structural change that comes out of it for sure. If you look at the history of US manufacturing, it kind of bled lower and struggled for for years and years and did a lot of outsourcing to China, but it was the GFC that absolutely hit it for six. It lost like 5 million manufacturing jobs in the GFC that never came back. There was just this massive offshoring push afterwards. Like it was an opportunity for corporates to just completely recalibrate the way that their whole production system. And so if that's going to go to some extent in reverse, it'll unquestionably have some structural implications. Yes.
Oh, and in terms of the way we're investing, I'm getting onto these next slides. I mean, that's absolutely the way we're looking at a whole bunch of different sectors. Like the sectors like the commercial real estate sector is a great example where all of a sudden companies all have to work from home. A bunch of companies are going to work out that, you know what, we actually don't need 100% of floor space for the office. We can easily get by with, people working home two or 3 days a week and have 60% of the current floor space. And so, yeah, there's a huge number of studies out there on disruption and disrupting events. Even stuff as simple as one of the ones I love is the guys have done a disruption event on tube lines in the UK being cut, and they find that a tube line gets taken out of focus off for repair for a week or something, and everyone has to change how they get to work. And then I can't remember the number, but it's something like say it's somewhere between 5 and 10% of people never go back to the old system that they went to because they found a better way to get to work, whether it be walking to a different place or whatever it is, or go stop by a different coffee store or whatever. When you have to disrupt, you just find different ways to do things, and often they're better than the old way. And so there's absolutely different things coming through, and so these factors in terms of the sectors we're looking at and the companies we're looking at to invest in over this period, they rate very highly in terms of looking for people who are benefiting from this disruption rather than losing from the disruption.
Sure thing. All right, thanks for that, guys. We'll jump across to how to invest.
Yeah. So one of the things I just wanted to highlight, and actually I saw a better chart. I think, David, you put one up. Somebody had a better one up where they'd stripped out the earnings a bit better than. So one of the issues, actually, let me take one step back first. The issue with stock markets is they're not actually that cheap from a long-term perspective. So if you assume that the current earnings expectations are right, and they have actually only fallen sort of 13% so far, whereas in the financial crisis they fell more like 40%, so sort of between 3 and 4 times as much. So if you took the current earnings expectations, which are very optimistic, then you'd say markets are actually looking a little bit expensive still. So they're 10% above what we saw at the bottom of the 2018, where we had that fall at the end of over Christmas. So they're still more expensive than where we got to there, and earnings really wasn't hit during that period. That was more of a scare about central banks tightening too much. And so if you actually said, well, earnings fall say 25%, then we're pretty much back to where that'd put stocks back at the highs we were at before we'd fallen. So basically, what you're saying is stock markets have fallen 25%, but if earnings have fallen 25%, then you're still very expensive, and you're still basically at post tech boom highs in terms of valuations, and saying, well, is this the type of market you would love to be buying at sort of at extreme valuations? Do you see heaps of growth coming out?
And so is this part of this is that, we're starting to see people are calling bottoms and seeing reshoots in the market, and there's buying further again. And is this just people concentrating purely on the price side and forgetting about the other side being the earnings bit for yours, Damien?
Absolutely, yeah. And the issue is, I'm sort of calling it the deer in the headlights for analysts. Like there's a lot of analysts who basically rely on companies to tell them how much they're going to make next year. So especially the first year, a lot of analysts just turn up to the company and say, well, we're thinking you're going to do 10% next year, and the company goes, that's a bit aggressive. And they'll go, well, what if we thought you were going to do 7%? Oh, no, that's probably a bit low. Oh, okay, we'll call it 8.5 then. Oh, yeah, that'll be about right. And so, and now they're turning up to the companies, and companies going, I got no idea what I'm going to earn next year.
Yep.
And so the analysts are sort of either leaving their old forecast there or reducing a bit. But I think what strategists are expecting.
consensus has fallen 3%.
Right. Yeah. So,
The entire economy is shut, but earnings are going to fall 3%.
yeah.
It's amazing, isn't it? Yeah.
And so you can't trust the numbers, basically,
Yep.
is where I'm getting to with this. That you're seeing in terms of don't sort of look and go, oh yeah, this company's fine. It's on a it's on a PE of whatever. I mean that's where a lot of the UK banks and European banks. We rewind a week ago. You're looking at those saying they're on PEs of 6 or 7, and the yield is 10%. And now we just found out, well, actually, no, the yield is now 0 because the
No
the Bank
dividends.
of England has said you're not paying dividends. So, and the earnings, are
The
based,
banks being the case in point.
yeah, and the earnings. I mean, to get those earnings, you basically got to assume that the government's going to bail out every corporate that has problems.
And so just in that vein, and so is the next big leg or decision point really for the market is the series of earnings that are coming out, and just a bit of an idea of the timelines of those. Who's first? Who are we waiting for to start to show the real impact on the economy versus through the earnings?
Well,
by country,
you can see the US. Yeah, the US. So you've just finished the March quarter. So you'll see the US earnings will start coming out in the next 2 weeks. You'll see those earnings kick over.
Yep.
But having said that, you're going to have within that you're going to have 1.5 good months, and possibly even more. 1.5 good months, one sort of a bit average month, and 2 or 3 weeks of really bad. So you'll see it a little bit, but you won't see the full amount.
Yep.
Will they start forecasting? That's the question. Will they keep throwing their hands in the air?
Yeah, I mean, most companies are. I mean, there's no requirement that companies have to give your guidance, and in the end, it's sort of a bit, when these things happen for a company that's not sort of on top of the whole, that doesn't have macroeconomists sitting around and looking at everything and trying to work out where things are going. They're not the people you really want telling you what next year's earnings are going to be anyway, because they're going to be drawing from whatever their own biases are without having sort of any feel for, or some of them will have no feel at all for the macro side, and some of them might be very good, but they really won't know what's going to happen. And so so for the next little while, like within our models, we use a lot of quantitative models, and we've completely wound back what our focus on forecasts within that.
Right. Yep.
To really focus on some of these longer term valuation methods in terms of what companies we're looking to buy. Needs a completely different angle to how you'd usually look at it. Is
there an opportunity in these earnings reports to basically say get the March component of the earnings and then just multiply that out by a number of months going forward? If you were going to try and do a forecast to say, well, if the economy is not going back, March is as good as an approximation as any, and so we can just multiply that bit of earnings out across the board to do a forecast.
You generally don't get that level of detail. Companies don't give it. Right. They might give a bit more, but the issue then is March really the right one, or because you're sort of saying, well, March might be right for say a 3-month shutdown, and then you want something somewhere in between that, because is this a company that will, is it going to be one of the first responders? So as things start to open up, is this a company that you can actually will start straight away, or is this one of the companies that's going to be one of the last ones to open up once everything gets back going again? So, it's those types of factors are very important once you're looking to see which stocks you want to actually buy.
Okay, sure, great.
So, I do my 6 or 7 different things. The key things to focus on.
Yep. So, how to invest? Yep.
How to invest? Yeah, slowly is the very first bit. And as Dave said, we're 8 weeks in. It was slowly, just need to relax with it. It's not something you feel you need to rush out straight away, but bear markets do have really big rallies. So you can get 50% rallies in bear markets. So quite frequently. So there's this whole thing about trying to pick the bottom. I want to be the one who got the day. And I'm like, well, I'm happy not to get the day. It's more about, for me, is trying to actually reduce the risk. So, and actually find that, yes, we don't want to be out there trying to catch a falling knife. And while there are still significant economic issues, trying to rush out and jump in, especially with markets not being particularly cheap. Keep in mind that those economic effects they haven't hit yet. We haven't seen it in numbers. We're 8 weeks in. We haven't even seen we haven't even seen a quarterly reporting season. Australian companies won't report until, for the most part, not reporting until July or August.
Wow.
So, you're months away from seeing what's going to happen. There's there's a whole part about a government's going to own everything. What are they going to buy? What aren't they going to buy? So which sectors are going to get bailed out, and which ones are actually going to get, a government's going to step in, which they probably should do, to be honest, in a lot of these sectors, and say, well, we actually want to save the employees, but the shareholders we don't really care about, the debt holders, well, you guys probably should be taking a pretty big haircut as well. So how ruthless a government's going to be, or are they just going to say, oh no, we're going to make everyone good, we'll buy these things out? And so it might be that the government's going to bail out, say, Virgin, in terms of an airline, they might look at and bail out. But does that mean you want to rush out and buy the shares for it? Well, not if the shareholders are going to get zero. So you need to be quite careful about what you're buying, even if there is a government backup, and trying to work out what are they actually going to do. There's going to be false starts. So in terms of our perspective, we're thinking as we put money back to work in the markets, it'll be a little bit at a time. We're not going to rush in. We're not going to wake up one day and suddenly go, oh, that's it. Crisis solved. We're back all into the market. For us, it would be more about saying, okay, we can see a few positive signs. Let's start picking up some stocks to a certain level. Actually, you know what? We got it wrong. You can wind back without sort of risking your whole amount. At the moment, we're looking at some of the countries that are doing relatively better. There's Singapore. Despite the fact they're needing a shutdown, they are actually getting onto it. They have been in front of the curve on most of these, and we think they're probably at least a fair way in front of the curve on the shutdown. A lot of other countries probably would have been in the similar position, would have waited another week or two to see more signs.
Yep.
Denmark's done quite well. They've been in quite early. Hong Kong. There are elements you can look at in terms of those.
And just on that note, Damien, just provide for newer listeners, I guess we've got the ability to invest in those markets through our portfolios.
Yeah. So what we tend to do is so we run just the high quality assets. So we only run government bonds and then large cap Australian and large cap international shares. So basically about 1,600 companies. It's called the MSCI World, which means they're all large, liquid. You can get in and out of them, and people own them in their own names. But so they're the types of companies. What we're looking for is if we can buy the good quality ones, put it into people's portfolios, and they're super. We run just ordinary super accounts as well. Is that if we can get them in at depressed prices and particularly high quality stocks that we want to own effectively forever, then there's a huge benefit from that whole not having the tax issues and because it's all in your own name and really getting the benefits of using this crisis to really up the quality of your portfolio and to sort of lock in years worth of stocks where you can just own them and not have to buy or sell them.
Yep.
So finding that bottom is important, but we're not in any. We were quite keen to try and be the hero to get out, if you know what I mean. Like we were very keen to get out early and go hard in terms of that, in terms of reducing the risk for portfolios.
Yep.
We don't feel any pressure to try and be the hero on calling exactly the bottom and getting in and going all in to ride markets higher.
Yep, sure.
So, and then the last country that's going to be the last part that it's going to be really interesting is some of these countries that are going to do the worst in terms of, say, the US and the UK might actually be some of the ones that come out faster. So it's not time to buy this yet. It's that's definitely looking over the valley. But just in terms of, let's say the US continue down their current path, which seems to be underreacting and actually letting the virus be being one of the worst places. If that's the case, it is quite possible that it will go through their population faster, and they might come out the other side faster because they've got herd immunity, because everyone's got it and a whole bunch of people have died, than other countries that have got prolonged shutdowns and are actually managing the whole health situation much better. But economically, they might find there's a longer period. So so some countries that are doing a bad job may well be out of this sooner than some of the ones that do a very good job.
Just with a lot less people.
With and upset populations and shattered hospital systems and a whole bunch of other factors. But it's not a it's coming back to that point that the health impact and the economic impact are not the same, and that in a lot of cases they're actually opposite. In that the wider you try and open your economy, the better the better your economy might be, but the bigger the health impact is going to be on your people.
Yeah, sure. Okay, wonderful. Thanks for that. We might just finish just on one last question as well, and I'll throw it open to both of you. Where do you see the AUD/USD heading, with the USA potentially suffering great losses and Australia keeping this thing in check? Will the AUD rise, gentlemen?
Dave, you're the specialist on this. Lost him. We might have muted Dave. I'm sure he might come back in a minute.
Feel free to come back when you're ready, Dave.
Yeah.
He's checking out the kebab shop.
Yes. So on the Aussie dollar, look. On the US dollar, look. Our view is very much that the US dollar, that US investors, which are some of the biggest ones in the world, will pull their money back to pull their money back to the US in the time of crisis. And so you will see US dollar strength.
Mm-hmm.
Australia is really it's what we call us a bit of a supercharged economy in terms of how it faces world growth, because we are so resource centric. So when the world economy is going well, the Australian economy goes really well. When the world economy is going poorly, the Australian economy goes really poorly, because it's got so much focus on resources which really need significant capital expenditure and world growth to keep up. So the issue for us is we think structurally, if economics are going to get worse, which we think there is a very strong chance they will, that the Aussie dollar is headed lower, and the safety trade about from US people just sort of pulling their money back to the US for safety will happen regardless of whether the US actually really is, from a stand back and survey the scenario, the safest place to be. We saw that very much in the financial crisis, where the US was a bit of the epicenter and of the whole crisis, but you still saw the US dollar rally quite strongly.
Okay, sure. And through our portfolios, how are we getting exposure to that one, Damien? Just finally.
Yeah, so we hold a lot of our cash outside of the Aussie dollar, and it's been a great hedge in terms of what we see is that on days when when stock markets are rising, you quite often see the Australian dollar rising as well, and so that sort of, we don't get as much of the upside, but the flip side happens where the days stock markets are falling. That very much nicely balances out any losses on the other side, and so we're looking at that. It does. We are tweaking the boundaries as we go, and just trying to make sure that we're keeping the weights at where we think is appropriate to hedge the risks. I'd be a lot happier to. I'm very happy not to participate in some of the sort of bear market rallies, or not participate as much in some of the bear market rallies, as long as you're saving yourself from the falls as well.
Okay, yeah, sure, good one. And just finally, and this is probably just a bit of a reflection on some of the questions I've been from clients and potential clients I've been speaking to, and actually ties into a question from Dan that we can finish on, which is the Reserve Bank Governor Philip Lowe has said that the bank would hold the cash rate at 0.25% until progress is made towards full employment, and is confident that inflation will be sustainable within their 2 to 3% target band. Now, we hold a lot of Australian federal government bonds in our portfolio. In fact, it's the only defensive asset outside of cash, variance of cash. So your thoughts on that note there? Are we expecting Phil lower for longer to sit on his hands for the duration?
Oh, absolutely. I mean, if anything, there's more printing coming. So if you had the view that governments have already done too much and there's this huge inflation bit coming, then you'd certainly be taking the other side of that bet. You'd be saying, well, now's the time to get out of bonds as fast as you can, but in our view, we're still very much of that view that the deflation is the biggest issue at the moment. Central banks are going to be doing everything they possibly can to stimulate, and what that means is that the Aussie central bank isn't raising rates anytime soon. And if anything, they're much more likely to be doing considerably more in terms of trying to push bond yields down. There'll be a question about whether negative bond yields are worth doing.
Yep.
I think the world's largely decided that they're not good. I don't think they are good. I think they create more problems than what they solve. I think central banks have largely also come to that same conclusion. They've been experimenting a bit recently, but that's potential as well. You could easily get negative yields in a number of different. Well, we already have negative yields, halfway around the world. You could see them in Australia. I don't think the central bank will target them, but they might. Depending upon how bad the crisis gets, and if we're talking unemployment of 20% plus, then I suspect they will have a license to pretty much try anything to try and help resolve the issues. And what the things they're trying aren't going to involve higher interest rates.
Okay, very well put. All right, fantastic. Well, we might leave it at that for now, and tidy that one up on a big show, on a very big topic on how and when and should we re-enter the stock market. So thanks very much, Damien, and to David, if you're still there. And we'll jump across to what's coming up next week. So we've got John Dinez he's the CIO of Paragon Funds Management, jumping in. He wasn't actually available this week for those who were listening in last week, so we've got him in for this week. For next Thursday coming. So we'll look forward to having a chat to John and finding out what his take is on, of course, what's been going on in the world presently and looking forward as well. So we'll see you there. Cheers. Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return we'll send you a weekly email with new webinar topics, links for our podcasts and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.